All right, let's jump straight into it. If you've ever looked at UK inheritance tax and felt a sudden wave of dread wash over you, you know what? You are definitely not alone. We're talking about a flat 40% tax rate here that can take a massive bite out of the wealth you've literally spent a lifetime building. But here's the good news. You absolutely do not have to leave this to chance. Today, our goal for this explainer is to transform that intimidating tax rate into a clear, empowering roadmap. By the end of our time together, you're going to have the knowledge you need to protect your family's wealth and secure your legacy. So here is our roadmap for today. We'll start by defining your taxable estate, then look at inheritance tax thresholds, followed by exemptions and gifting rules. After that, we'll navigate probate and payment, and finally wrap up with reliefs and upcoming pension changes. Let's get going. Section 1. Defining your taxable estate. What actually counts? Okay, before we can protect your wealth, we really have to know the foundational rules of the game. I want you to reconsider your assumptions for a second here. What exactly is an estate? Most people assume an estate is just the bricks and mortar of their property, maybe the cash sitting in their checking account. But assuming that your estate is limited to just those obvious things, well, that's actually one of the most common ways people end up in costly disputes and massively underestimate their tax liability. Now, what's really interesting is just how broad the definition of an estate truly is. Honestly, it catches so many people completely off guard. Yes, of course, it includes your property, your home contents, vehicles, money. But check out these other items. Jointly owned assets? They count. Certain insurance payouts? They count too. Currently, certain pension benefits can even be factored in depending on exactly how they're structured. And perhaps the wildest part, the one that surprises people the most, assets you've already given away within the 7 years prior to your passing are pulled right back into the calculation. HMRC casts a very, very wide net. Moving on to Section 2, the inheritance tax thresholds, stacking your allowances. So now that we've seen how big the estate can actually be, let's look at how we can stack your tax-free allowances to shield it. Think of these like building blocks. Every single person in the UK has a standard allowance called the Nil Rate Band. This base allowance is £325,000, and get this, it's frozen until April 2031. Anything below this line is totally tax-free. But wait, there's an add-on. If you're passing your main residence down to direct descendants, so your children or grandchildren, you can utilize the residence Nil Rate Band. This gives you up to an extra £175,000. Add those together, and an individual can potentially shield up to £500,000. Though keep in mind, this residence band actually tapers off for larger estates, reducing by £1 for every £2 your net estate exceeds £2 million. But the crucial point is this magnificent number right here, £1 million. Because for married couples and civil partners, you can combine and transfer these allowances. It's fantastic. If one partner passes away and leaves everything to the surviving spouse, their allowances aren't lost. They just transfer right over. This means a surviving partner can potentially have a massive combined tax-free threshold of up to £1 million before HMRC takes a single penny. But what happens when you cross that threshold? Well, that is where the tension begins. For any value in your estate that sits above those tax-free allowances we just built up, the standard inheritance tax rate drops like an absolute anvil. A heavy, flat 40% goes straight to HMRC. That leaves only 60% of that excess for your loved ones. It is a really steep cliff. There is, however, an immediate relief mechanism you should definitely be aware of. If you leave 10% or more of your net taxable estate to a qualifying charity, HMRC will actually reduce your overall tax rate from 40% down to 36%. It's a brilliant way to ensure your wealth goes toward a cause you really care about. You're helping others while actively shrinking that tax bill at the same time. Section 3. Exemptions and gifting rules. Let's open up your IHT toolkit. So what can you do right now while you're still alive and kicking? This concept is the absolute cornerstone of proactive lifetime wealth transfer. It's called the 7-year rule. Simply put, if you give a gift of any size to someone and you survive for 7 full years after making that gift, poof, it becomes completely exempt from inheritance tax. It vanishes from HMRC's radar entirely. But let's be real. What happens if you don't quite make it to that 7-year finish line? That is exactly where taper relief kicks in. It's a sliding scale. If you pass away between 3 and 7 years after making a large gift, the tax rate applied to that specific gift slides down. It goes from 40% down to 32 to 24, all the way down to just 8% in year 6. But please hear this carefully because it's a huge misconception. taper relief reduces the tax rate, not the value of the gift itself. And it only kicks in if the total value of your gifts exceeds your Nil Rate Band. Now, aside from the 7-year rule, there are immediate, no-waiting required exemptions you can utilize right now to start chipping away at your taxable estate. First off, transfers to a UK-domiciled spouse or civil partner are completely exempt, regardless of value. You also have a £3,000 annual exemption you can just give away every tax year. On top of that, you can make unlimited small gifts of up to £250 per person. Just a quick heads up though, you cannot combine that with the $3,000 allowance for the same person. And finally, you can make tax-free one-off gifts for weddings or civil ceremonies. Seriously, use these tools, they are right there waiting for you. All right, Section 4, Navigating Probate and Payment, the Execution Phase. Let's step into the shoes of the executors for a minute. These are the people you leave behind who actually have to sort all this out. They must follow HMRC's incredibly strict 3-step valuation process. First, the executor has to identify every single asset and debt. Second, they have to estimate the exact value on the exact date of death. And third, subtract the debt from the gross value to find the net value. I literally cannot stress this enough. Accuracy is paramount here. If HMRC suspects deliberate inaccuracies or omissions, they won't just ask nicely. They can launch investigations going back many years and issue very heavy penalties. And your executors, well, they have to do all this math while racing against a ticking clock. The deadline is honestly pretty harsh. Inheritance tax must be paid by the end of the 6th month after the death. Think about that. If someone passes in February, HMRC expects their check by August 31st. That comes up fast. And after 6 months, HMRC starts charging interest on late payments. Which leads us to the ultimate probate paradox, the catch-22. You have to pay the tax before probate is granted, but the assets are completely frozen until you get probate. I mean, how on earth do you pay a tax bill with frozen money? Fortunately, executors do have some solutions. They'll need to submit the main IHT 400 form, and to unfreeze funds, they can use the direct payment scheme. That uses Form IHT 423 to have banks pay HMRC directly from the deceased's accounts. For illiquid assets like property, you can use Form IHT 422 to opt to pay in annual installments over 10 years, though keep in mind interest does apply. Or, and this is brilliant, if you have a life insurance policy written in a trust, it pays out outside the estate entirely. That provides immediate liquid cash to cover that hefty tax bill. Finally, Section 5, Reliefs and Pension Changes. Looking to the future. As we look ahead, there are specialized wealth shields to be aware of, like agricultural relief, which can actually offer up to 100% relief on farms. But there are also massive legislative shifts coming down the pipeline. Take business property relief, for example. Historically, this has been an incredibly generous way to pass on a business. But starting in April 2026, a new cap is coming. 100% relief will be capped at £2.5 million per individual. Any qualifying assets above that 2.5 million threshold will only get a 50% relief, which creates an effective 20% tax rate on that portion. Plus, if you hold AIM shares, those will only receive 50% relief from the very first pound. And remember, you absolutely need a minimum ownership period of 2 years to qualify for any of these. And here is the truly critical, urgent warning for the future. For years, financial advisors have touted pensions as the ultimate tax-efficient safe haven, simply because they sat outside your state. But the government has announced that from April 2027, unused defined contribution pension pots will become subject to inheritance tax. This is huge. It completely shatters previous assumptions and represents a monumental shift in wealth planning. Which leaves us with this pretty provocative question. Is your current estate plan ready for the April 2027 pension rules? If you've been relying on your pension as a tax-free vehicle to pass down wealth, well, the game is changing. You now have the knowledge. You understand the surprisingly broad definition of an estate, the thresholds, the 7-year rule, the probate catch-22, and these looming future deadlines. But knowing the rules is just step 1. I strongly recommend you take this roadmap we've discussed today, consult a qualified tax accountant, and get your plan updated right now. Take control of your legacy today. Thanks so much for joining me on this explainer, and I will see you next time.
If you are looking for professional guidance, give us a call today. Sit back and relax while we do all the complicated work for you.